Let's take a minute to review the risk warning before we start. The risk warning states that trading in Forex CFDs and other derivatives is highly speculative and carries a high level of risk. It's possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. Seek independent advice if you necessarily need it. So our today's topic is the fundamental analysis for solid strategy. We will now start our topic. I think everybody has already joined. So today's topic will be about fundamental analysis. So the fundamental analysis is a very wide topic, but today we will speak about the most important points that we will need in our trading. Let's start by identifying what is fundamental analysis. So we are speaking fundamental analysis in Forex market. Okay, it's very specified definition because, as I mentioned, fundamental analysis is very wide. So we have to specify which market are we focusing on, and we today speak about fundamental analysis for the Forex market. So fundamental analysis in Forex market is evaluating a currency intrinsic value by examining the various economic indicators and news events. So unlike technical analysis, if you were in our last webinar, we were speaking about technical analysis, which focus in the price chart and patterns. Today, we will speak about fundamental analysis, which look at the broader economic picture. So the economic picture is what fundamental analysis look. First, you need to know that there is three main economic goals that each economy trying to achieve. First goal is max employment. The economy should ensure it provides the max number of job opportunities to its citizens, and of course to decrease the unemployment rate to the least percentage. The second target or the second goal of any economy is stability, to ensure the economy is stable by controlling inflation. Okay, this is the second goal. All these terms we will come to discuss later in the webinar. The third goal of any economy is the growth. The government or the economy should focus on growing the country's GDP, gross and development. The stage of business cycle. This is the stage of any economic cycles. We will now discuss it one by one. So the economic cycle is fluctuating state of economy from periods of economic expansion and contraction. Okay. So it's usually measured with the gross domestic product, the GDP of a country or a region. So there is also other economic factors such as employment rate, consumer spending, and interest rate can also be used to determine the stage of economic cycle. So we have to understand the economic cycle. We will now discuss it. So in today's world, everyone is in a market-based economy. So the law of supply and demand determine the prices of everything. Okay, so the economic cycle is a trend. It should be upward and downward movement of GDP that ultimately determine the overall long-term growth of an economy. Let's analyze it. Okay, during the expansion phase, this is the expansion phase. So the economy will experience strong growth in the GDP, and interest rate will generally be lower, but will begin to increase as the expansion matures. The overall production level increase and inflation rates begin to rise as the expansion matters. So the peak reach, this is the peak reach when the growth of an economy reach the maximum rate. This is usually characterized by higher inflation that need to be corrected. So from this peak, the correction occurs through the contraction phase. The contraction, this is where the growth of the economy slow down. the unemployment rate rise, the inflation tapers off. It continue until the cycle reach a trough. So the trough characterized as the low point, the lowest point in the economy from which it can re-enter an expansion phase again. So the cycle will start over. So now let's see it again, the whole shape of the economic cycle or the business cycle. It starts with the expansion, then peak, then go down until it reaches the trough, try to go down again, an expansion until its peak. If you can see this line, let me go back for a moment, use this laser pen. Yeah, if you can see this line, this is the perfect line. This is the line we want to always be in. So above this line, there is inflation, and down of this line, there is, bad economy. We are trying always, each economy is trying to reach this level. We always try to be in this level. We avoid the peak and the trough. This is the stages of the business cycle. This is the main target of the economy, to achieve this line, to be between the peak and the trough, to be between the contraction and expansion. And this actually affects all of us, as we will see in the coming information. Every person is participant in the market-based economy. So the defining factor of the success of a market-based economy is that it should make everyone better off by producing more and consuming more goods and services over time. This is the goal. Everyone should produce more and consume more. This is the definition of a success economy. The GDP of an economy capture the increased production and consumption levels, and growing GDP is an important aspect of a successful economy. So given that everyone is a participant in the overall economy, it makes sense that everyone is impacted by the state of the economic cycle. It's usually in everyone's best interest for the economy to be in an expansion phase to accumulate more wealth. So actually what we are speaking about, not only we are interested in as traders, but always we interested in this as human beings, because this economy is actually shaping our life. So when the economy is an expansion, business generates profits, which leads to hiring more employees and more disposable income and spending. So it in return lead to more profit for the business, and then it continue in this cycle. So when the economy is in the opposite direction, in contraction, the business lose profit, which leads to downsizing and laying off employees. So when the employees lose their jobs, there is less disposable income and less consumer spending, which lead to even lower business profits. So it continue in this cycle. You now understand it. So this is all related. This is a cycle. So an economy should be in continuous expansion. However, the contraction are needed to keep inflation in check and to make sure the economy does not overheat. So an overheated economy is an economy that has experienced a long period of strong economic growth, but also has begun to reach high level of inflation. Inflation that is too high lead to inefficiency within the market-based economy. So as you see, this is a cycle. Now, we have mentioned a lot of terms, a lot of economic terms that we will now define. This is actually the key economic indicators that we use to identify in which phase are we now. The first term we will speak about is interest rate. This is when the central bank, such as the Federal Reserve or the European Central Bank, they set the interest rate that influence currency values. Higher interest rate typically attract foreign investment, so it increase the demand for that currency, so it make this currency go higher in value against other currencies. So let's have this example. The Fed, the Federal Reserve in the United States, they set the target interest rates at which banks lend to each other overnight to maintain reserve requirements. This is known as the Fed fund rate. And the Fed also set the discount rate, the interest rate at which banks can borrow directly from the central bank. If the Fed if the Fed raises the interest rate, it increases the cost of borrowing. So this makes both credit and investment more expensive. This can be done to slow an overheated economy. If the Fed lower the rates, it makes borrowing cheaper, which encourages spending on credit or investment. This can be done to help stimulate a stagnant economy. So in this graph, you can see the global interest rate now. This is the actual interest rate now. If you can see it here, the USD, this is the United States dollars, this is 5.5%. This is now the interest rate that's decided by the Fed. Here in the other side, you can see the the Bank of Japan interest rate, it's 0.25%. Okay, this is the actual numbers, but let me give you some hint that market actually try to predict what the central banks are going to do for the interest rates, and because of this prediction, the foreign currencies move against each other. For example, now we predict that the Fed will start cutting the interest rate. He will decrease it from 5.5. And we, for example, predict that the Bank of Japan will increase the interest rate. So you will see that the United States dollars will decrease against the Japanese yen, only because we predict, before that even happened, because the market predict this will affect the currencies against each other. So now you will understand why the interest rate is a very key indicator in the economic cycle and how it can affect your trading. We will, of course, make some live trading examples at the end of this, but let's move on and speak about another key economic indicator, which is the inflation rates. Actually, before we define it and speak about it, the interest rate is trying to control the inflation. So what's the inflation? The inflation affects purchasing power. Central bank may adjust interest rate to control inflation, impacting currency strength. So each indicator is related to the other. We were speaking about interest rate, now we are speaking about inflation. Actually, they are related. Okay, you can't separate one from the other one. So inflation rates is the, as I mentioned, affecting the purchasing power of individuals. So central bank, they adjust the interest rate to control inflation. So this impact the currency strength. So what is actually inflation? If we try to identify the inflation itself, inflation is gradual loss of purchasing power. This reflects the bold rise in prices for goods and services over time. So inflation actually means that your money now can buy less than yesterday. This is inflation in the simple term. The inflation rate is calculated as the average price increase of a basket of selected goods and services. This is now I'm speaking about the inflation numbers. When you see inflation numbers in the in the news, this is how they calculate this inflation. This is increase prices of a basket of selected goods and services over 1 year. So high inflation means that the prices are increasing quickly, while when we have low inflation, this means that prices are growing more slowly. It should always grow, as we will now see, but when we try to get it lower, growing slower, this is the target of the central banks. but it will grow anyway because of what we will speak about right now. Inflation measures how quickly the prices of goods and services are rising. So inflation is sometimes classified into three types. There is three types of inflation. We will just mention them now, and we will discuss them later. There is the demand pull inflation, the cost push inflation, and built-in inflation. We will explain them one by one. But now you have to know that the most, yeah. I think I have some question. Yes, now we are in the inflation. The most commonly used inflation in the indices are the consumer price index, the CPI, and this is the CPI. We call it CPI. So inflation can be viewed positively or negatively depending on the individual viewpoint and rate change. Those with tangible assets like property or stocked commodities may like to see some inflation, as that raises the value of their assets. So now, if you can see my screen, please confirm, send me if you can see my screen. Yeah, this is now the three types of inflation. If you can see now in the left, the demand pull inflation, this is when demand for goods and services exceed the production capacity. For example, there is 100 pens. Let's speak about pens. Okay, we all want pens to write with. There is 100 pens in the production. So then more students came to study, and there is now 120 people want to buy these pens, and the pens only 100. So when the demand increase with the same production, this will increase the prices because more people are willing to buy the product, but the production capacity is not exceeding. Actually, it's less. We have products less than demand, so the demand is very high. So this lead to the demand pull inflation because the price increase because of this demand. The second type of inflation is the cost push inflation. This is when the production itself increase in prices. So let's keep it with the pen example. Now the factory of the pen is trying to get the ink and plastic, every component of the pen. So let's say they were producing the pen in the cost of, let's say, $1, and they sell the pen in like $1.50. So when the production cost increase, it's now become $1.25 to produce the pen, and the factory want to keep the $0.50 margin of profit. So now he will increase the price to be $2 or $1.75 to meet the increase of the prices and the profit margin. So the cost push inflation happen when the production cost increase the price. The third type of inflation, we call it the built-in inflation. This is when the price rise because of the wages rise. You know, let's have this example. The same pen now increase in price. So the worker who has his children in the school, they want pen. They come home and they ask it to increase their money because the pen are going now higher in prices. Work and ask for a raise in his job because now he need to spend more to have the same amount or the same quality of life he has. So when the worker asks for this increase, the factory will increase his wage, but they will increase their prices to meet this increase in wages. So this is like built-in inflation. This is when prices rise because wages rise too. So in order to maintain living costs, this will be like, we call it the built-in inflation. This will always be here. It's like a cycle. So this is the three kinds or types of inflation: the demand pull inflation, when the demand increase but the production is the same; when the cost push inflation, when the cost of production increase; and the built-in inflation, when the wages increase. So this, of course, increase the prices. Now let's move on to another key economic indicator. We spoke about it, we mentioned it many times, which is the GDP, the gross domestic product. What is GDP? So GDP measures a country economic performance. A growing GDP indicate a strong economy, which can strengthen the currency. So what the gross domestic product or the GDP, actually it's the monetary value of all finished goods and services made within a country during a specific period. You have to understand this because we don't count the unfinished goods. So for example, some car is using leather seats. We don't count the leather seats in the GDP. We count the car with all the finished goods in it. So the GDP provides an economic snapshot of the country used to estimate the size of an economy and its growth rate. The GDP can be calculated in three ways using expenditure or production or income. And it can be adjusted for inflation and the population to provide a deeper insight. The real GDP consider the effect of inflation while the nominal GDP does not. There is a lot of kind of GDP as you see. Okay, though it has limitation, but the GDP is a key tool to guide policymaker and investor and business in strategic decision making. We also, as traders, we look to the GDP and we use it as economic indicator. Also, we have another key economic indicator, which is the employment data. The employment data, such as the non-farm payroll, we will discuss this later. We call it the NFP in the US. This provide insights into economic health. Higher employment rate usually strengthen the currency. So let's take a minute to speak about the non-farm payroll because this is very important news. This is a measure of the number of people employed in the US, excluding farming, private household, non-profit, and active military employees and property. So when are the non-farm payroll released? The data is commonly released on the first Friday of each month. This is commonly the date, the first Friday of each month. This happened at 8:30 a.m. Eastern time. This equals the 4:30 p.m. Dubai time and 12:30 p.m. GMT time, Greenwich time. So this reflects the previous month's data, and the non-farm payroll is not a leading indicator, but it provides a snapshot of incidents that affect the overall economy. Also, there is other key economic indicators, but this is something we don't have actual timing of. This is the geopolitical events. So political stability and international relation can significantly impact currency values. For example, political unrest or trade wars. We have a lot of political tension happening right now. This can lead to currency depreciation. So this is an example of the economic calendar. You can see this in a lot of places. This is the economic calendar in GoDoCM, our website. You can see here the time, and in the left, if you can see my laser pen, please confirm. Here it's the time, and this should be by your local time. And then the currency, this affects what currency, and then the event itself, what the event is. Normally, it will be having something like gray or yellow or red. Red is the biggest impact on the currency. At the other side, at the right side, you'll see the actual and forecast and previous. The previous is the last time we have this news, and the forecast is what the market is predicting, and the actual is when the news come. And it's always the forecast what matters to us as trader. So when the market predicts something, if the actual numbers came worse than prediction, this is bad for the currency. If the actual came better than what we predicted, this will be good for the currency. This is the general rule. Okay. We now ran out of time, so I will have your question. Someone asked about a real-time example. Okay. Today we had some news from the US regarding the employment. This is not the NFP. The NFP comes only once each month, but each week we have unemployment rate. So at this time, if you can see, this is a 1 minute chart for the US dollar against the Japanese yen. We had a news at this time. It was 4:30 p.m. Dubai time, and this was actually decreasing in the jobless claims. The people who are seeking the unemployment rate were less than expected. So this made the USD, the US dollar, jump against the Japanese yen from 146. It was around 146 for each dollar. You pay 146 Japanese yen. Now it's trading about 147.26. This is around 126 point. This is huge. So what this actually telling us is that the dollar is increasing, the dollar value is increasing against the Japanese yen. That was because of this news. This is the answer of your question about a real-time example for how the economic indicator affect the market. Okay, today's time is up, but next time, inshallah, we'll be speaking about how to combine the technical analysis with the fundamental analysis, because we actually, as I believe, and most expertise believe, that you can't have one without the other. Technical and fundamental should not be against each other. For us as Forex traders, we are trying to make profit from this market, so we can use whatever tools which provide the best value for us. And for me and for all the best expertise in the field, I see them always say that fundamental and technical is like just having two arms. So which you prefer, to fight with one arm or to fight with your both two arms? I think it's logical to have both in your side. So next time we'll speak about this. And if there is any more questions, someone asked about gold. Yes, we will have the same in gold, but maybe the impact was not in the same direction. It will be opposite direction, because here we will have the XAU, which is gold, against the dollar. So you will see here it was the news. Actually, there was decreasing. Gold also have some geopolitical events that happening. So I think even what's coming for the dollar news will not make the gold go the direction of US dollar only, because there is other events. So when we analyze gold, we need to, of course, think about US dollar, but also there is a lot of other things. Maybe next lecture we can talk more about gold, and when we combine the technical and fundamental, we can understand how we can use this to trade in commodities like gold. So for now, what I can tell you is, you can see this is the 1 minute candle of the news. It was down until this, actually it went down for a long time, then something else happened and reverse. So if there is any more question, if there is no more question, I will end this now. Okay, please join our upcoming webinar. It will be next Thursday, same time, 6 p.m. Dubai time. We will hopefully be here discussing combining technical and fundamental analysis in actual live trading. Thank you for your time, and hopefully we will meet soon. I will end this now. Bye-bye.